You're listening to Uranium Spotlight, brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
It's Tuesday, August 19th, 2025, and this week on Uranium Spotlight, spot prices edge higher on thin summer trading. India opens its uranium sector to private capital. Switzerland moves towards ending its nuclear ban, and GoviEx rebrands as Atomic Eagle with a new ASX listing. The uranium spot price closed last week at $72.80 a pound, edging up from $72 the week before. Trading volumes are thin, which is typical during the summer doldrums. Many participants remain on the sidelines or on vacation, leaving the market more exposed to individual buyers and sellers who can move prices with relatively small transactions. The week's most notable activity came on Tuesday with two spot deals, a 100,000-pound delivery at Cameco and another 50,000-pound lot at Orano, both priced at $72.50 a pound. By Friday, bids had firmed up again, and another late-day 100,000-pound Orano deal helped lift the spot indicator to $72.80. That capped a modest but steady gain of 80 cents over the past 2 weeks. Forward pricing also kicked higher. 3-month delivery quotes now sit at $72.50 at Cameco and $73 at both Coverdine and Orano. These increases reflect a market where even with limited spot demand, buyers are still willing to pay slightly more for nearby material. Meanwhile, the term market continues to show more consistent activity. Several U.S. utilities recently made selections on contracts covering deliveries from 2029 into the 2030s, and one non-U.S. utility has an open request for nearly 900,000 pounds a year stretching out to 2036. That's a strong reminder that while short-term activity is slow, long-term demand remains both steady and sizable. For investors, the takeaway is clear. Spot market action may be thin and volatile in the summer, but the structural demand story is very much intact. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. India is now preparing to open up its uranium sector to private companies, allowing them to mine, import, and process uranium for the very first time. The move comes as the government pursues one of the world's most ambitious nuclear power build-outs. Until now, India's state-run nuclear corporation has held a complete monopoly over uranium, everything from importing to mining, milling, and fuel fabrication. But as India looks to multiply its nuclear generating capacity by 12-fold, the state alone cannot meet the challenge. The country has very little uranium of its own, and projections suggest it will need to import as much as 75% of the fuel required for its new reactors. At the same time, it must dramatically expand its fuel processing capability to handle the growing demand. This change opens the door for major Indian conglomerates like Tata Group, already one of India's largest corporations, to participate directly in the uranium sector. That could mean developing mines abroad in uranium-rich regions, partnering with established miners, taking stakes in existing operations, or securing supply through long-term contracts and the spot market. The influx of private capital should, in theory, help fund new mines and drive more exploration globally. But the timeline reality doesn't change. Uranium mines still take an average of 15 years to move from discovery to production. That means any boost to supply will come too late to prevent the supply crunch expected around 2027. India's demand growth will only add pressure to an already tight market, especially when layered on top of China's expansion and reactor restarts in the West. One clear shift, though, is that a sector starved for capital for decades is now attracting serious money. If Indian industrial giants begin competing for uranium assets, it could help rebalance the long-term supply picture. But in the near term and medium term, it's far more likely to intensify competition for scarce supply. For investors, this is another signal that uranium demand growth is real and accelerating. India's private sector entry won't solve the supply deficit, at least not anytime soon. Instead, it points towards stronger demand, more competition for contracts, and ongoing upward pressure on uranium prices. Switzerland now has two competing paths to end its ban on building new nuclear reactors. The first is a popular petition led by the Stop the Blackout movement, which seeks a constitutional amendment guaranteeing utilities the right to build reactors. It already has over 600,000 signatures. The second is a parliamentary initiative that would reverse the ban through legislation, potentially followed by a referendum. Amending the Constitution would be far harder than passing a law, and the government has called the petition inefficient and riskier than its own legislative plan. Still, if neither proposal succeeds before August 2026, the issue will automatically go to a national referendum. Axpo, the country's largest utility, which operates about 60% of Switzerland's nuclear fleet, says it has no immediate plans to build new plants even if the ban is lifted, not without major financial support. But momentum is shifting. Capital markets are beginning to reopen to nuclear investment, and governments across Europe are eager to support it. This is part of a broader nuclear revival. Public opinion has turned more favorable. Governments are rewriting energy policy, and financing is becoming available in ways we haven't seen in decades. The reality is clear. To meet climate goals, nuclear has to be part of the mix. That raises the bigger question: where will the uranium come from? Switzerland joins India and other nations moving to expand nuclear capacity, but global uranium demand already exceeds supply by an estimated 30%. Western utilities, particularly in Europe, are drawing down stockpiles. No one wants to risk shutting a reactor for lack of fuel, and since uranium is a relatively small portion of operating costs, utilities are prepared to pay higher prices if it guarantees security of supply. What this means for investors: momentum towards new nuclear builds in Europe underscores the widening gap between demand and available uranium supply. As policy shifts accelerate, utilities will prioritize securing long-term contracts, even at higher prices. For uranium equities, this translates into stronger fundamentals, more pressure on exploration and development, and rising importance of security of supply. GoviEx Uranium has announced what it's calling a transformational deal. The company will complete a reverse takeover of Tombador Iron, giving it a new ASX listing and access to the deep mining capital pools in Australia and the Asia-Pacific region. The combined company will be renamed Atomic Eagle, with GoviEx shareholders retaining about 75% ownership. This move not only brings a new exchange listing, but also significantly tightens the capital structure. The share count will shrink from more than 1 billion down to roughly 345 million, which should improve trading liquidity and reduce volatility. On top of that, Tombador brings $10.4 million Australian in cash, and a concurrent financing of up to $10 million Australian would lift the new company's treasury to as much as $24 million Australian. The board will be chaired by Govind Freeland, with Daniel Major staying as CEO. Matador Capital, known for its early involvement with Boss Energy and Lotus Resources, is joining as a cornerstone investor, with Grant Davey serving as strategic advisor. Importantly, the new Atomic Eagle will continue to focus on advancing the Muntanga project in Zambia, one of the largest underexplored sandstone-hosted uranium systems globally, with strong potential for scale and improved project economics. For investors, this transaction is significant. It puts GoviEx into the ASX ecosystem, where uranium equities have historically traded at stronger valuations than in Canada. With a healthier balance sheet, a leaner share structure, and experienced backers, Atomic Eagle is positioning itself to be one of the better capitalized African uranium developers at a time when new projects are critically needed to meet global demand. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.